to teach your kids about economics. What you don't know about retirement could hurt you. And do you think Anthony Weiner uses Snapchat? This is Your Money, Your Wealth. Today on Your Money, Your Wealth, Joe and Big Al chat about economics with Michelle Balconi, co-author of the children's book, Let's Chat About Economics. Plus, the fellas debunk retirement myths, and Joe quizzes Big Al on the 8 things most Americans don't know about retirement. The fellas also answer emails on Roth IRAs, 401ks, and investing. Now, here are 2 guys who wouldn't know Snapchat if it snapped them right in the IPO. Joe Anderson, CFP, and Big Al Clopine, CPA.
Alan, I got some big news for you right now.
You do?
This could be my last show.
So you mean I get to take over?
Yes. I got this email.
Right.
And I want to share it with you.
Okay.
And I want your advice on this.
Okay.
So it says, Dear friend, I won't say her name, but she is one of the wives of the late president of the Democratic Republic of Congo.
Congo. Okay.
Yeah. Consequently, upon the assassination of my husband, I am in possession of $58 million. These funds are being earmarked for special projects.
Yes.
This fund has since been deposited in a security company in West African country of Togo, where I'm residing now with my children. It is now my intention to move the said fund out of this place, Togo, to a safer place for the benefit of the children and I for immediate investment.
Okay.
Based on this, I am asking for your assistance to enable me to take this money out of Togo. However, note that my children and I have agreed to give you 20% of the total fund if you can accept the offering of assisting us.
Wow. So you could retire on that, huh?
20% of $58 million.
$58 million?
Also, it will be my responsibility in directing us on a viable business. All right, so I got some responsibilities for this newfound fortune.
You got to do something. Now, do you have to marry her?
Wait for it. It is also my intention to relocate and probably take temporary residence in the country pending when all the troubles in my country will be resolved.
Okay.
We advise that you look for a house we will buy as soon as we arrive. To conclude this transaction, you will be required to come to Togo to open an account in the bank here in Togo, where the security company will deposit the total sum in your favor. From this bank, the money will be remitted into your original bank account in your country. Immediately this is done, all of us will depart Togo to your country, where my children and I expect to take temporary residence.
Got it. Okay.
Boom. Look at that. Found a wife, kids.
It's 18, 19 million, just like that.
Please note that I cannot open up a bank account in my name because my late husband's first son, Joseph, who took over power of our country, don't want to see me or my children. He claimed that when our husband was alive, that I was very close to him than any other wives, including his mother. He also claimed that because of my closeness to him, I was able to get things from him more than others. As a result, he has been monitoring me. In fact, this is one of the main reasons I want my children out of our country and to live with you.
Wow. That's quite an elaborate email.
There's a little baggage, I guess, that goes along with this.
A little bit, but, for all that money.
Well, I'm just...
You're retiring?
I am.
From the profession?
I am done.
And let's see, you and 50 million other people got that email?
I don't know. I don't think so, Alan.
You don't think so? You think it was written right to you?
I think so.
It said, Dear friend, not Dear Joe.
It says, Dear friend.
I love your podcast.
Yes.
Dear friend.
Dear?
I usually get ones from somebody in England that has $12 million to deposit.
Well, see, $12 million. I had $58 million.
It's a much better deal.
They went straight to the source.
And I don't think I got an offer to get 20-25%, but you never know.
Yeah, but I have to travel there.
You do.
Get them out of harm's way.
Well, you've got plenty of vacation.
I do. I have a couple days banked up.
Yeah, a couple of years, I think.
So, yeah, I just wanted to say goodbye to my newfound future.
So, if you are one of the other 50 million people that got this email...
You're too late. I've already booked my flight.
Yeah, Joe's already taken it. However, I will also say, clearly, what they're trying to do is get your bank account info so they can take money from your account. So be careful.
Oh, really?
Yes. I know I spoiled it for you.
So when I go over there, you don't think...
No.
They're not going to open with open arms?
In
Red carpet?
Country of Tonga.
Toga?
Toga.
T-O-G-O?
Yeah.
I know Togos. It's good sandwiches. That's all I know about Togos.
Right. It's probably similar.
Yes, it's
They got great sandwiches.
yeah, but you know what? There's a lot of scams out there. You got to be very careful.
You do.
With filing your tax returns, and I guess as financial advisors, as Al and I are, we tend to get, I don't know, half a dozen of these? It seems like a week.
Yeah, usually, and I like it where they say "dear friend," or they say something like, "Through extensive research, through the web research, we have found you."
So,
But they don't call you by name.
yes, of course, yeah. They did. Yeah, they have our crack research, Steve.
they're utilizing our crack research team. Right.
Yes. So anyway, $58 million. That sounds pretty attractive.
Well,
20% of that.
It does. It's 20, and I did my math wrong. 20%?
20%.
20%. So that's about 11 million. I said 17, but still that's a good figure. 11, 12 million.
Well, if I look at if it was 60 million, 20% of 60 million is 20 million.
60.
Or 12 million.
Yeah, that's right.
Yeah, 12 million.
Yeah, see, I had said 18. I don't know what I was thinking, but anyway, yeah, it's close to 12.
Yeah.
Still, it's
so
a good,
she knows we're pretty good with math.
Yes.
That's why she's going to give me $8.
Extensive research.
That's about 20% of 58 million.
We're thinking $8. Wow, this is great.
Oh my!
Buy me a cup of coffee and lunch.
Oh my God! This is a financial planning show, and Al and I are a little rusty on the numbers here. We don't have a calculator.
Yeah,
Last weekend, though. Last weekend,
Mom.
Yeah, Ruthie's going back to Minnesota.
Oh, okay, it's
been 2 months.
Yeah, a couple months. Well,
two and a half.
This is her winter home.
Yeah,
you do know that.
Yes, I know.
You bought a large home in anticipation of this. Does she live on a different floor?
Yes.
Yeah.
I put her in the basement.
Or a little tent in the backyard?
No, she's got a nice little master suite on the first floor. So she doesn't have to walk up the stairs.
Okay.
Yeah.
Right. So you got your own second floor.
Yeah.
You kind of even almost have a third floor, right?
Yeah. I guess it's a deck.
A deck, patio outside.
Yeah, patio.
Yeah.
So.
And if you had a basement, you'd have 4. Huh?
Yeah. Well, I could dig one.
Yeah, you could.
I suppose. Oh boy! I got an interesting question from a listener. And we were talking about Social Security, I don't know, a couple of weeks ago.
Right.
And was confused on the spousal benefit. All right. And so she heard that she could collect on an ex-spouse and didn't necessarily believe us.
Right.
And so the rules on this, Alan, is that if you were married to someone for over 10 years, right, or 40 quarters, right, 10 years of marriage,
yes, right,
and you haven't remarried, you can still claim on your ex-spouse's spousal benefit.
And if you have more than one ex-spouse for 10 years, you can take the better of the two.
The better of the two.
Or the 3, whatever.
Right, yeah. So, Rob Rogers and I are going to come up with an app. Right?
So you figure out which spouse will be better?
Or, you just take a look at your current spouse's benefit.
Right.
And then we will have an app that will say this spouse's Social Security benefit is this.
Yeah.
So your spousal benefit would be X.
And so
you just got to divorce your current spouse, marry this nice.
Well, then there'd be a check, just to make sure it's like the 10th year in a day, and then then you got to get an alert.
Yeah.
Divorce.
Yeah,
Divorce.
Exactly.
Divorce.
Yes. You'll beat 4 times. And then the app will automatically go to an attorney's number.
Right.
Right. Fast divorce or something like that.
And a Seeking Millionaires website, because you got to trade up.
Yes, right. It's newfound fortune.
Yeah, right.
So, but the spousal benefit works like this. You can take your benefit or your spouse's, half of your spouse's benefit. It actually doesn't work that way, but it's easier to explain that way. So if you take a look at your spouse's benefit, let's say their benefit is $3,000 and your benefit is $1,000, right? Well, what they do is they give you your $1,000 benefit, but then they also increase it to $1,500. They give you an extra $500 because that would be half of your spouse's benefit.
Right. We're talking monthly benefit, right?
$1,000 a month.
Yeah, right.
Right. And so you have to take a look to say, all right, well, let's say I'm single now, and if I have an ex-spouse, is that spousal benefit higher than my current benefit? Then you can elect to take the spousal benefit. Now, there's some rules that have changed recently. So if you are 62 years of age by last year of 2016, you can still file a restricted application. And what that means is that you can then claim your spouse's or ex-spouse's benefit and then let yours continue to accrue or grow. But that individual had to be taking benefits. So there's a lot to this stuff, but just say that we were not lying to you. Yes, you can actually claim on an ex-spouse's benefit.
Social Security is likely to be an important part of your retirement, and as you just heard, it gets complicated. To learn how to maximize your Social Security benefits under the new rules, sign up for our free Social Security webinar on Tuesday, March 28th at 10:30 a.m. Pacific Time. Go to yourmoneyyourwealth.com. Yeah, you see up there in the top where it says Maximizing Social Security Benefits under the new rules? Click that to register. Then log on to the free webinar on March 28th. Joe will teach you about claiming strategies, how to calculate your benefits, what benefits are available, and how they're taxed. If you've got Social Security questions, email info@purefinancial.com, and Joe will do his best to answer them during the webinar. That's the free Social Security webinar on Tuesday, March 28th at 10:30 a.m. Pacific. Register at yourmoneyyourwealth.com. Now, I think Joe and Big Al have a guest they'd like to talk to.
Big Al, very special guest today.
We do. We got a great author, actually, that wrote a book that even you and I could understand.
Barely. I needed this book. I'm telling you. The book is called Let's Chat About Economics. It's basic principles, through everyday scenarios, but it's a children's book.
It's first book on economics that you and I have ever understood.
Oh my God, yes. And it's a quick read.
It is.
And then you get to understand, law of diminishing returns.
Oh, you were paying attention.
When I read, Al, I focus. We have the author, Michelle Balconi, on the telephone, and I just want to thank you very much, Michelle, for joining us and taking a little bit of time to chat about economics.
Well, thank you so much for having me. This is a real treat.
I'm looking at your book right now, and you got these little kids, so you have these different chapters, and they have different stories. And what was the genesis behind you writing a children's book about economics?
Sure. The genesis was a real experience. So I think really powerful writing comes from a personal place. And my husband and I have 2 children. And a few years ago, we were fortunate enough to see Dr. Arthur Laffer, the economist, speak to, a room full of people. And he's a very charismatic communicator, in addition just to being brilliant. So based on his speech, my husband and I went home and had a fantastic conversation with our children, who were 10 and 12 at the time. And, we had this really robust dinner time conversation about economics based on, very simple, easy to understand examples that Dr. Laffer gives. And our children came up with their own examples. And it was so powerful that I searched for a book that would keep the conversation going. And while there are a lot of, I would call them business-minded books that are really great for kids, there was nothing that used real economic terms that could really continue the conversation with our children. So I reached out to Dr. Laffer. He's a grandfather and great-grandfather, and suggested that we write together, and he just jumped on board.
Oh, that's awesome. I mean, with how you bring complex, the law of diminishing returns. It's like, oh my God, I'm going to fall asleep.
Oh, I love diminishing returns. I love it. Who wants to work harder than they can achieve benefit from? That's shoveling the driveway, not in San Diego, but, if you're in a snowy climate, why would you shovel the driveway past the side door? That's what our son told us, There are reasons why you do that, but they got him thinking about how hard are you working and what benefit are you deriving. That's diminishing returns for kids.
Right. And then opportunity cost. It's like, hey, well, I want to go to a tropical vacation. And then, all right, well, figure it out. Let's kind of take a look. How are we going to get there? We have a budget. Walk through some of these stories for us.
Well, I love these stories because they come from my family, and I love my family conversation. So the idea with the book is to replicate connecting with your kids, because that was a very powerful experience that we have. So these stories revolve around, things that families are doing anyway, going to the grocery store, planning a family road trip, deciding on activities in the summertime. And then we've given readers charts, graphs, really whimsical, fun graphs to illustrate the economic principles. So the example that you bring up, the road trip, how do you go on this tropical vacation, on a budget? We've created a chapter that teaches the law of diminishing returns and opportunity cost, which is the thing that you gave up. When you make a choice, there was something that you didn't choose, and that's the opportunity cost of that decision. So we do it through a good old-fashioned family road trip, and the chart, or graph in that chapter literally illustrates reaching the warmest temperature for the least expense. It's like, bam, for kids, they get it. It meets them where they are. It uses examples that come from their life, and then it encourages parents or grandparents, whomever's reading the book to these kids, to really connect with kids with their own choices. What time do you get up? What do you wear? Are you going to have the brownie or the ice cream sundae? There's an opportunity cost with that. Just meet kids where they are. Talk about their choices, but teach them the real economic terms in the process. And then they will be, like travel sports where you're playing baseball year round, right? Especially in Southern California. Getting your 10,000 hours in, becoming proficient. Well, chatting with kids about economics on a daily basis with the decisions they're making anyway allows them to be economic experts.
Michelle, I know you wrote this book for children, but are you finding adults are understanding terms that they never understood before?
Yes, they are. Thank you for asking that, because the adults are the secondary audience. So not only do the stories allow the adult, like I said, a parent, a lot of grandparents contact me. They're reading it with their grandkids. They're saying they learned, or now they are relearning economics and applying it to their everyday choices.
Alan had to read a book like this to figure out the Keynesian theory. I did. It was all about fish. It was also a kid's book, and I finally got it.
That's funny.
I think.
Well, it's such a blessing to me. I get to work with Dr. Laffer on this really important topic, and we're actually working together on 2 additional books, one on democracy and one on immigration. We connect on the idea that, economics is not political. It really isn't. The application of economics is political. And he's a person that worked, years ago with Jerry Brown on developing a flat tax plan. He is a person who voted once for Jimmy Carter, for, President Kennedy and President Clinton twice. He says this in every speech that he gives. Obviously, he was a part of President Reagan's administration. He supports good economic policy, no matter who's using that on either side of the aisle. And that's what we want to teach our kids. This is not a political book. We do introduce taxes in Chapter 3, the summertime chapter, because we relate it to kids who are receiving allowance, and then how much are you going to save? It's spending versus saving, which we introduce with milkshakes and piggy banks and a great graph for kids that instantly get it. But then mom and dad in the story talk about, well, hey, if we're paying so much in taxes, where's your incentive? We teach incentive. Where's your incentive to work? And the children in that story go through the same process. Should I do double the chores for double the allowance because now I have to save half my allowance? Or should I do no chores for no allowance so I don't have to give up half of it and then do free stuff? Well, the chapter also teaches that nothing's free. So these are real conversations. These are robust back and forth. That's why we titled the book Let's Chat. It's a conversation between adults and children. And it teaches them 26 real terms.
The supply and demand, too, is I think... people hear that and they're like, yeah, I know what supply and demand is, but I really, truly don't think they
don't
get
really,
it.
Right.
They don't get it. It's like, and then so with the story of, all right, well, let's have kind of a Thanksgiving type of feast, but not in November. And then going to the grocery store and saying, hey, well, why isn't there a lot of turkeys here?
There's
and
just a couple.
Yeah, what's going on here? And so like with our business, of course, we, help people with their financial security. And some of that has to do with stocks and bonds, and then helping them understand, pricing, what is the price? Well, it's all based on the supply and the demand of that particular, widget, commodity, or whatever that you want to place in that placeholder.
You're exactly right. And, economics, true economics, is the same economics in the personal family budget as it is for the employer of those parents, as it is for the state that they live in and the country they live in. Economics is scalable. So I, as you can tell, am very passionate about bringing this lesson, economic lessons, to children. And the book was written for 6 to 10-year-olds and their parents or grandparents. So establishing that at a really early age and then helping parents, either helping them or reminding them that economics is around us in our everyday life. It surrounds us. Even if you're making a decision like a child would, how am I spending my time after school? Am I, hanging out playing Xbox? Am I in the driveway working on my left-handed layup? I'm trying to make the team. Those are economic decisions because time is a scarce resource. So, I get really pumped up because I do work with kids in schools. I also actually work with adults and people who have acquired a lot of wealth in their life. And then they're, doing planning to pass that on to their children and their grandchildren. They don't know how to have that conversation about economic decisions. Well, here's the platform for you. In 4 easy-to-read stories, which take less than 10 minutes to read each. There's a total of 26 economic terms in there.
And I think at the end of the day, it's, well, do I want to go through the trouble to try to help my children understand this, or even my spouse or partner or whoever, or do I just buy the thing? You know what I mean? It's like,
right.
Hey, I want the Xbox. Okay, well, I could go through all of this where I don't necessarily have a platform, or just buy it. Like Big Al is still buying his kids sneakers with the Air Jordans. They're 30.
So you're part of the shoe game. The shoe game is big in our house. Let me tell you, those Nikes, you can buy and sell those things. Our teenage son just sold a pair at a profit. So I understand the shoe game. More importantly, he understands economics.
Michelle, I wish we could chat a lot more, but we got to go. And I just want to thank you so much for what you're doing. I think this is awesome. It's giving people a platform to have really good economic and positive conversations. I think that will put staples on kids' lives for a very long time.
That's what I'm hoping. And economics just isn't for the professor in the corduroy patched jacket. I'll tell you that. It's for everyone.
Hey, how do they find more information about this?
Sure. We have a website that gives more detail about the book, including all of the places that it's available for purchase, which, of course, includes Amazon and Barnes & Noble. But if your listeners would go to www.letschataboutecon.com, they'll find everything they need.
That's Michelle Balconi, everyone.
Time now for Big Al's List. Every week, Big Al Clopine scours the media to find the best tips, do's and don'ts, mistakes, myths, and advice to improve your overall financial picture in handy bullet point format. This week, 5 retirement myths debunked.
When it comes to retirement, a lot of us only retire one time, right? And so you don't really know what you don't know until you do it. So let's talk to the experts, listen to the experts, let's listen to those that have retired and figure out what are the myths, what are the things that really aren't true that we think are true. And the first one, Joe, that a lot of people believe is that stocks are not good investments for retirees.
That's what they think.
That's what we're told. We're told when you retire, you got to go safe. You got safety because you can't afford to lose money, right? And there's no way to make it back. You don't have enough time to make your principal back. Well,
here's the problem with that type of thinking is that your retirement date is not your end date.
Right.
Yeah.
I think that is a good way to think about it. And particularly, let's just say you retire at 65. And we know what the stats are right now. An individual that's a male is, on average, lives to about 84, right? A female lives to about 88.
That's the average.
Average,
right?
Yeah. Half less, half more. That's actually the median, if you want to be specific. That's the median age.
Thank you.
Yes, for you mathematicians out there. And when it comes to a couple, when you put a husband and wife together, the median is around 90 90 years of age. In other words, at least one of them will live to age 90.
So it's not the finish line. It's not the retirement, and then you have this rope, and then you run, you put your arms up, and then, hey, I'm finished.
Yeah, maybe in the old days you retired at 63 and you
died
lived
at 64.
68 or something. It didn't matter. But now retirement can be 25 years or longer.
Right.
Right.
I think a lot of our listeners, their retirement years are going to be longer than their working years.
In many cases, right.
And so, yes, you absolutely, in most cases, it all depends on your specific situation, how much money that you have, of course. But over the long term, stocks have outperformed bonds because they have more risk, and with that risk, you're compensated for it. So there's a higher expected return.
Right.
And so you probably need that higher expected return in your overall portfolio to make sure the portfolio will sustain itself over the next 30 years, right?
Yeah, and that doesn't mean you should have all stocks.
Of course not, right.
You need to have a balanced portfolio, and the way we like to look at it is it takes a little bit of work to figure out what sort of rate of return do you need to make this all work, and then figure out what a portfolio should be to earn that rate of return. No more aggressive than you need to be. And so, in other words, maybe you'll have 30, 40, 50% stocks, maybe the rest in real safe type investments, so that when the stock market does correct, and we know that it does, it's just part of what it does, then you're not hurt as badly. And the other part of that is that you have enough safety that you can liquidate safe CDs, government T-bills, things like that in times of market correction. So you don't have to touch your stocks. You don't want to sell them while they're down. In fact, that's actually when you want to buy a little bit more, because then you're going to get a higher expected return after that.
Yeah, don't be afraid of stocks in retirement. Do not. They're going to help you long term, without question. So that helps you accumulate the wealth. It's going to continue to sustain your portfolio long term.
Another myth. Myth number 2. There is no need to worry about health care because of Medicare.
Oh, we just talked about that in our TV show.
We sure did. We know that, 62% of your health care is covered through Medicare, which means 38% needs to come from you.
Right, 40% roughly, let's round. So that's a big chunk.
Right.
And so you got to be careful here. And what is the statistics? What if you're a married couple, it's about $250,000. That will give you a 90% confidence level that you will have enough to cover those additional medical expenses.
Yeah. So
we're talking co-pays.
Right.
We're talking
Everything.
out-of-pocket expenses here, right?
But we're not talking long-term care. That's over and above this. But yeah, that's what the stats will tell us. That's what Fidelity says anyway, and other organizations that look at this, is a married couple age 65 are going to need around $250,000 for medical costs. And just to be clear, and it's not that you have to have $250,000 in the bank for medical, because you'll be funding some of that through your pensions,
cash flow,
through your income, through your Social Security. But that's how much that you're going to have to set aside. And I think a lot of people that think about retirement planning, they just assume that Medicare covers everything, and it doesn't.
Right. Not even close.
Right.
62%.
62. to be exact. Number 3, your tax bill will disappear in retirement. That's a myth.
Yes, that is probably one of the largest myths for most of our listeners.
Yeah, that's definitely not true, because if you think about it, when you retire, think about where most of your savings, retirement savings, is. Well, it's in your IRAs and your 401ks and your retirement plans. When you take money out of those retirement plans, it's fully taxable in general, and so you have to pay ordinary income taxes on that. Social Security, up to 85% of that is taxable. Your interest income, your dividends, taxable. Your rental income, taxable. Everything's taxable for the most part, unless you've done some tax planning and you move some money from your retirement accounts to a Roth IRA, then at least part of it is tax-free. But I think a lot of people assume that taxes aren't going to be that big a deal, or they'll be in a much lower bracket. And we find just the opposite. For those that have done the right thing and saved money like they've been told, they end up in the same, or in some cases, higher tax brackets in retirement.
It's most often the case when you've done the right thing, unfortunately, right? Because what have we been told is to save as much as we possibly can, and where most people save their money is in the retirement accounts, because, hey, that's what I was told. I get a tax deduction today, gross tax deferred, and I'll be in a lower tax bracket in retirement. But no, you need to absolutely kind of take a look at, all right, well, how's your income going to be taxed? What's your goals? What's your other income sources? And come up with a strategy to mitigate that. We've talked about that a million times here.
Here's another myth. Social Security will replace your work income.
That's what people think, actually?
That's what apparently. And this article says that Social Security replaces about 40% of your pre-retirement income. That's not been my experience when I've looked at this. I would say it's more like 25 to maybe 30% of your income is what it replaces.
Again, it depends, of course. I mean, I would say a majority of the population, that's probably accurate. Because there's not a lot of money saved in these retirement accounts by most people.
Well, you're probably right. So let me rephrase that. Our listeners, it may be 10% of your pre-retirement income, right? Or your job earnings, or 25%. But yeah, you can't necessarily count on it being a lot. And the whole idea of Social Security is mainly just to make sure you're not living in poverty, that you can have a place to live, you can turn the lights on, you can have a little food, but it's not exactly a robust lifestyle if that's all you got.
There's all sorts of different strategies that you might want to take a look at, too, when you claim your Social Security benefits. So you want to maximize that. The longer that you wait, right, the more money that you do receive. So if you are looking at Social Security as one of the main sources of income, you probably want to push that thing out as much as you can and work as long as you can to maximize that benefit.
Yeah. The last one, Joe, this is a myth that annuities are never a good choice for retirees. And interestingly enough, I would say that many people have negative connotations about annuities, including us, because they don't really end up performing the way that they're promised, and they tend to be pretty expensive in terms of internal fees. The people selling them often, not always, but often get pretty high commissions. But there are certain kinds of annuities, like lower cost immediate annuities, or maybe qualified longevity annuity contracts that
QLAC?
Yeah, QLAC, that could be worth a look. The immediate annuity, Joe, you put money in right, and then right away you get a payment stream.
If you need a free financial assessment, if you missed an episode of the podcast, or if you're just dying to see what Joe and Big Al look like, visit yourmoneyyourwealth.com. Access the Learning Center with resources, white papers, and webinars on investing and financial planning. Subscribe to the podcast and see clips of the Your Money, Your Wealth TV show, all at yourmoneyyourwealth.com.
Okay, folks, let's test the big brain on Big Al.
Okay, what do you got?
I got 8 things most Americans don't know about retirement.
Okay.
Are you ready?
Are you going to see if I actually know them, or?
I'm going to quiz you.
Yes, okay.
I have questions.
Okay.
You answer the questions, and I will tell you if you're right or wrong. All right.
Okay.
Question number 1. Roughly, how much do investment professionals say people should save by the time they retire?
How much they should save as relationship to their salary, I suppose? Okay, I'm going to say 8 to 10 times.
Correct response. At least 10 times the amount of one's last year's salary.
Yes.
Good job, Alan.
Okay, good.
Fidelity said that even though professionals disagree somewhat about how much the average person needs to save, because you might say, hey, save 15% of your salary.
Right.
But that's not going to do anyone any good if they're 64 years old and don't have anything saved.
Yes, exactly.
You know what I mean?
Right.
Or, if you say, hey, save 15% of your salary, and then you're like, well, I was saving 25%. So should I bring it down to 15?
I could spend more, you're telling me?
Right? No, save 25%.
Well, you are right. I think that 15% is good if you're in your 30s or maybe early 40s. But if you're in your 50s, you got to get a little more sophisticated.
So check this out, though. 19% of pre-retirees age 55 to 65, guess how they answered that question?
Oh, as to how much they had to save?
Mm-hmm.
I don't know, 5 times?
2 to 3.
2 to 3? Really?
Yep.
Wow. Okay.
So.
Okay. All right.
10 times, folks. That's the goal. Get to 10 times. If you're making $100,000, that's $1 million.
But every year you get a bonus. You go, darn, I can't retire again this year.
Here we go. Question number 2.
All right.
How often over the past 35 years do you think the market has had a positive annual return?
I would say 70%.
The market has enjoyed a positive annual return 30 out of the past 35 years. Historically, the U.S. stock market has gained about 7% per year.
30 out of 35. I don't have the calculator, but that's probably a little over, about 75%.
It's pretty close to
something
what
like
your
that.
answer is.
Yeah.
So, again, gold star for
Check.
Big Al.
Check 2.
Only 8% of overall respondents answered correctly.
Oh, really? Okay.
Those between 55 and 65 did slightly better, with 14% responding correctly.
Really? Okay.
So I think when you ask that question, and all of our listeners heard the question,
Yes.
I'm guessing, what do you think? They'll probably say 50-50.
Yeah, probably, yes.
It depends, though. You know what? Right now, today, because markets they were at 21,000. Now it's a little bit under that, but it's still, right, all-time highs. That's all we hear. Hear. So, that recency bias is just so real. It's like, well, man, the market's been up since '09 and this and that.
Yeah.
I would say it's even higher.
Yeah, 90%, right?
And then if you asked that same question in 2008,
Yeah.
what do you think the respondents would say?
Yeah, less than 50. Yeah. And
Market's never up.
I was just, we just had the 8th year anniversary of the bull run, right? Because March 9th, 2009.
Did we have a party?
It was this last week. We missed it. I actually
Did you have a cocktail?
I talked to Ann about it.
Did you?
And it's funny because a lot of people don't realize the Dow at that point was about 6,500 points, something like that. 6,800 points, and now it's over 21,000. I think a lot of people don't realize we've had an incredible run since 2009.
Yeah. You just want to make sure that you're always defensive.
Right.
It's all right. Well, here, don't just start loading up on stocks now. You just got to take care of what you're trying to accomplish. All right, let's go. Question number 3. If you were able to set aside $50 each month for retirement,
Okay.
how much could that end up being 25 years from now, including interest, if it grew at a historical stock market average? Well, you don't have your calculator, do you?
I'm going to do this without a calculator. $50 a month so that's $600 a year for 25 years. I'm going to say 100,000.
That's a little bit less than that, Al.
Okay.
About 40.
40. Okay. Give or take.
16% of respondents answered correctly. Big Al, however, did not. However, 47% underestimated how big an effective relatively small savings can be over time.
Got it.
All right.
So 2 correct, 1 fail.
Yep. Let's see if you can get a passing grade.
Okay.
Given your current average life expectancy, if you want to retire at the age 65, about how long would you need your retirement savings to last?
Okay, well, it depends whether you're male, female, or a couple. So I'll answer all 3. If you're male, 19 years. If you're female, about 23 years. If you're a couple, 25 years.
Yeah, very good, Al. It's approximately 22 years, given that the average life expectancy is 87, or 85 for men and 87 for women.
There you go.
So, right on target. Let's see. A third of respondents got that answer right. 38% estimated that they would need to make their savings last for about 12 years.
12.
Well, if that's your financial plan, you're blowing yourself up.
Well, and of course, the flaw with that question is if that's half the people live to that age, the other half live longer. So you really got to plan longer than that.
So what's the median?
Median? Yes.
Thank you.
Yes.
All right. The big brain.
I've only been stumped once in the last century.
Good. Stump Big Al. Remember that segment?
Yeah,
that was a
right.
great one. You got stumped today.
Anytime you ask me a question about a movie, I always was stumped because I don't know anything. I've seen the movies, I just can't remember anything.
Well, did you watch that uplifting movie that I told you to watch?
Which
Manchester by the Sea?
Oh, that one? No, I'm not going to watch that
Barrel
one.
laughs.
I watched La La Land. I like that kind of. It's got to be happy.
Approximately how much did the average monthly Social Security benefit pay in 2016?
2016, it was, I'm going to say around $1,000 to $1,100.
$1,300.
$1,300.
I'll give it to you.
Close.
It's pretty good. 43% of respondents answered correctly. Better yet, half of pre-retirees did so. Fidelity pointed out, however, that with upward of 75 ways to claim and dozens of factors that influence one's decisions when they retire, $1,300 is just simply the average. So I'll give it to you, Al.
Okay, close
All right.
enough.
So cruising here. We got just a couple more. About what percentage of your savings do many financial experts suggest you withdraw annually in retirement?
Well, the standard answer is 4%. However, I will add, if you retire younger, like say 55 or 60, you might want to keep it closer to 3%. If you retire later, like 70, 75, you could probably get away with a 5% distribution rate.
42% of pre-retirees answered correctly. And Big Al, of course, you were right on the money there. But check this out, Al. 38% of those 55 and older said they could withdraw 7% or more from their savings annually.
Right, and I'm sure some said 10% because that's been the historical average of the stock market.
And 15% of this age group felt that they could withdraw 10 to 12% annually. Thanks for blowing that bubble of mine.
I stole your thunder.
You did?
Yeah.
Damn it. But right, okay, so here we go. We got a lot of these people, 55 and 65, they're going to withdraw 12%. If you draw 12% out of your money, you're done in 12 years.
Right.
Yeah, good job.
Yeah, right.
Okay. All right, what do we got here? What do you think is the single biggest expense for most people in retirement? Big Al?
Let me think here. I'm going to say medical.
Okay. Housing, healthcare, and transportation are typically the largest expense in retirement, but housing by far tops the list for most Americans.
Housing, okay.
Housing. For many retirees, housing can make up nearly half their expenses.
All right. Well, that to me was the obvious answer, but in a lot of cases, retirees have paid off their mortgages, and so then it's cheaper.
17% of these respondents and 13% of those between 55 and 65 answered correctly. But 69% thought healthcare would be the largest expense.
I was in good company.
Big Al. Fail.
You know what I just read, Joe, was the most hated tax. I mean, a survey of a bunch of individuals. The most hated tax, you would think it would be income taxes, but it's not. It's property taxes. And it's property taxes because you have no control over it. It just keeps going up, and you can't come up with deductions. You can't reduce your income. There's nothing you could do. Just pay it. And that's part of the problem with housing is even if the home's paid off, you got property taxes.
What is your biggest?
My biggest expense?
No, not your. I don't. You got a big wallet. I don't care about your biggest
Vacations.
expense. Yes, it's my African trips, Joe. What tax do you hate the most?
Me, income tax.
Yeah. Right?
I mean, that's
property tax.
That's the big one. Now, of course, but we live in California.
Big one for Big Al.
But we live in California, though, Prop 13. So our property taxes are somewhat under control relative to other states. So I'll put it that way.
All right. Here's the final question, bud.
Okay.
About how much will a couple retiring at age 65 spend on out-of-pocket costs for health care to cover the course of their retirement?
$250,000.
Okay. Only 15%. It's 260 now.
Okay. I missed it. So
only 15% answered correctly, with 72% underestimating the true amount of healthcare costs. Overall, 22%, including 19% of pre-retirees, underestimated how much they would need to spend by about $200,000.
Wow. Okay. So I got, 5 out of 7? That's passing. That's over 70%.
I'll give you 6.
6? All right, even better.
I'll give you 6.
I got a B+ then.
No, actually, I'm not going to give you 6. I'm going to give you 5.
C-.
C-. CPA for over 30 years. You can't get 8 questions right. Folks, don't ever call Pure Financial Advisors.
We don't know what we're doing.
Oh, boy.
Joe, I've got some tax news you can use.
All right, tax news.
Audits, the dreaded IRS audit, the numbers of audits are continuing to decline rapidly. In fact, I guess if you look at 2015, or this is 2016, excuse me, the individual audit rate fell to 0.7%. So that's only 1 out of every 143 tax returns actually get audited. And as recent as 2011, it was over 1%. And most of the audits these days are through the mail. You just get a letter in the mail saying, hey, you know what? You claimed $75,000 for salary, and we got $80,000. So we think you owe us tax on that extra $5,000 of income. If you agree, pay it. If you don't, tell us why not. That's how most audits are being conducted these days. And it's all a factor, Joe, of the cutbacks in the budget for the IRS. And each year they seem to have less and less resources. But that's good news for everyone else out there because there's less chance of being audited these days.
Why is that good news, Al?
It's good news for our listeners.
Well,
no one wants to be audited, Joe.
Well, I think our listeners are honest upstanding citizens.
Yes, they are.
That if they did get audited, there's nothing to worry about.
But I can't tell you how many very good people, good and honest people, they just have such fear over an audit, and they want to avoid an audit at all costs. And being a CPA, I've been to several audits. They're not near as bad as you might think. They're not fun. I'm not going to say they're fun, but they're not as bad as you might think. But like
the movies might
Yeah, a little bit too dramatic. Now, when it comes to corporations, that's interesting. The overall business examination rate was 0.49%, so that's even lower. And partnerships and S corporations were under that rate, 0.38, 0.34. So what's the lesson there? If you want less audit exposure, you incorporate or you set up an LLC as opposed to being a sole proprietor.
Question. Let's say I have an S corporation.
Yeah.
Would there ever be advice for me to switch to a C corp?
Yes, although there's not a lot of great reasons to. An S corp is a flow-through entity, so whatever the profits are, you pay for individually. With a C corp, the corporation pays its own profits, and there is no flow-through. The downside of the C corp, of course, is that you can be double taxed on that income because corporations have profits, they pay taxes on it, and if you want to get those profits, you declare a dividend, you pay taxes again. But there are some advantages of a C corporation. For example, you could set up a medical reimbursement plan. You have to cover all your employees, but your employees can submit their medical bills and get a reimbursement, and the company can deduct it. So in essence, you get to deduct your medical expenses. Now, most C corps don't have that policy unless it's owned by one person and there's no employees. You see that a lot of times with professional doctor corporations. That way they get to deduct their medical. In other cases, when you are a technology company and you need venture capital money, they'll almost always insist that you switch to C corporation because they don't want to pay taxes on the profits. So
yeah, I wouldn't ever see the reason to go only because of the healthcare. Right?
Yeah, there's not a lot of reasons to do it, and as for that reason, when you incorporate, you would almost always go S corporation.
It's time to dip into the email bag with financial questions courtesy of Advisor Insights from Investopedia and you, the Your Money, Your Wealth listeners. Today, the fellas answer questions on contributing to a Roth IRA, 401k, or both, investing excess cash for the future, retirement contributions while receiving a disability pension, and buying individual stocks. Don't forget, Joe and Big Al are always willing to answer your money questions. Email info@purefinancial.com, or you can send your questions directly to joe.anderson@purefinancial.com or alan.clopine@purefinancial.com.
Okay, are you ready, buddy?
Yeah, what do you got?
Since you failed the quiz, we're going to go into...
I got C.
All right.
I got 5 out of 7.
All right, where should I move my market earnings to avoid any losses on the funds is the title of this.
Okay.
All right. I have earned $1.4 million in stocks.
Okay.
I want to transfer this money out of the market and into a traditional IRA. I don't need to make more money. I just want to keep what I currently have and not risk it to losses. Is this a suitable strategy? Signed, Worried
about the all-time high market. 1.4 million in stocks. That's pretty good. Oh, she wants to transfer it to an IRA, or is it he or she?
Worry Wart is the name. Walt. Let's call him Walt.
Walt's worried about. I wonder what that means, transfer to an IRA. Does that mean it's in a 401k?
Yeah, I'm guessing, yes.
Yeah, so he wants to transfer that to an IRA. And when you have money in a 401k and when you leave your employer, that's an option that you have, which is it's called rolling it to an IRA, which you can do, and it's tax-free. So that's, and generally, I'd say more often than not, people do that because there's more investment choices. But let's just say, we said his name's Walt. Let's say Walt did pretty well in the stock market during his working years, but now he's retiring and he wants to make sure it's safe, right? And of course, that's what a lot of people do when they come to retirement. I can't afford to lose it.
We talked about this, is that, all right, well, your retirement date is not necessarily the finish line, right?
Yeah, right.
And so he's like, all right, well, I got $1.4 million. It's all in stocks. I'm feeling pretty good. I don't want to take any more risk. Let me put it in cash. Right. I'm going to move it to an IRA, and then what do you suggest where I don't lose any money? Right.
And so to just simply answer the question, you could put it in a CD.
Treasury bills.
Right? Treasury bill, probably shorter term rather than longer term because there's more chance of losing principal.
Yeah, treasury bill, not a bond.
Yeah, right. Treasury, right. Okay. Thank you, Mr. Joe Anderson. But really, is that the right thing to do? And the answer is no, because if you're retiring and you're age 65, I mean, you're probably going to need your money for at least 20 years, maybe 25 years or longer. So you're going to have some growth. Yeah. So I'm all for having plenty of safety in your portfolio, but not 100%. It's not all in versus all out. It's finding that right allocation for you in retirement.
Okay. Here's one for you, buddy.
Okay.
I currently own a Roth IRA with my bank, which I invest in regularly. My employer offers a 401k, but no match contribution. Okay. Should I still participate in the 401k for the benefit of the tax deduction, or should I continue with my Roth IRA?
That's a good question. I think when we go through the Joe Anderson order of saving.
Thank you for the acknowledgement there.
Yes, that's where I get it from.
TM.
Trademarked. We usually say start with your employer's 401k up to the match. But if there's no match, there's not a particular advantage. So actually go ahead and go right to your Roth IRA and fund that. That's $5,500 unless you're 50 and older. Then it's $6,500. And then maybe you go back to the 401k and start loading that up.
I totally agree with you, Bud, but I think there's no match here, so then we have to dive in a little bit deeper. He's already have the discipline to open up a Roth IRA at the bank and contribute to it regularly, right? And so congratulations there, because the 401k is a lot easier, right? It's already out of your paycheck, out of sight, out of mind. So I like what he's currently doing, so I wouldn't want him to stop doing that.
Right.
But yeah, I think a little bit of both is probably the right answer.
Yeah, and I think I know where you're going, because when it's 401k, it comes out of your pay. It's pay yourself first. It's automatic. You don't even think about it, and you tend to save more that way.
Right. Absolutely. Because something might happen next month where he's putting money in, and guess what?
I'm not going to do Roth this month because the car broke down or whatever.
Oh, and then next month, well, I'm not going to do Roth this, or maybe he funds it annually. Well, I can't do it this year just because of this, or I got the. If it comes out of your paycheck, you kind of start to adapt and spending what
You're
comes
right
in.
about that.
So I think the correct answer is to find out exactly how much money that you should save to accomplish all your financial goals. Save that money and spend everything else. All right. How should I look to invest excess cash later in life without an immediate need for the short-term gains? All right, so this individual is 77 years old and has about $60,000 in cash to invest. He also has 3 401k accounts worth $250,000. I don't need the immediate cash. How do you propose I invest this excess cash? In an index fund? Is that a smart and safe play? Ooh, 77 using play. He's hip.
He is. Look at that. Huh? What did you say? 66,000 cash?
60 grand.
60 grand. 250,000 in the 401k. Of course, we need to know a lot more information to answer that question, but I'll take it maybe a couple ways. If you need, or you think you're going to need the $60,000 within, what would you say, 4 or 5 years, then keep it super safe. Go with a CD or government T-bill, something like that. But if you really don't think you're going to need it for a while, you could then go to the market. You could go to an index fund. There's all kinds of index funds. You could go to a total stock market index fund or any number of things. But I think the real answer is we need to know a lot more information about your situation before we tell you how to invest this $60,000.
I know. That is the most common question.
We get that all the time because people like to compartmentalize their assets, right?
Wow.
Yeah, you like that? I've been listening to Joe Anderson.
That's a big word. Big word from Big Al. But it's like, God. And then all other, I'm like addicted to like other financial podcasts.
Yeah, and so you listen to them all the time. Yeah.
Oh, it's like nauseating of the advice that you hear.
Yeah, tell me, what would be a common response with that question on what
you have $60,000? Oh, go to TD Ameritrade and buy Vanguard's. What? It's just like, what the hell are you talking about? All right. Well, you're 77. What's a good place to park the money? There's no way that you can give that advice appropriately.
No.
You know what I mean? Yeah. I don't know. Buy Snap.
Right.
There you go. Snapchat. That's my advice.
It might go up.
It could. IPO was just last week.
Right.
Imagine that. You ever play with Snapchat there, Big Al?
No, my kids use it all the time, though.
I've never even heard of it. What the hell's wrong with me? And I'm not old. Maybe I am.
You need to have kids that keep you young.
What Snap? Is that the one when you get something with like bunny ears on it or something?
No, it's sort of like a way to communicate with each other or a group, but then everything disappears.
Was it video?
It could be anything, I think, but then it disappears quickly, so it's not a permanent record of your life.
So does Anthony Weiner use it?
I suspect that would be a perfect application for someone that likes to do that sort of thing.
Yeah, he should have used a little Snapchat.
Yeah, instead of texting.
Okay. Can I still contribute to a Roth IRA if I have a disability pension? This is an interesting question here.
Okay.
I'm married, 56 years old. My wife works, and I'm on disability at home all the time.
Okay.
Okay. Can I still contribute to my Roth IRA that I've set up before I went on disability? What's your answer there, Big Al?
When it's disability income, if that was the only income, no. Did it say his spouse worked?
Well, let's say if his spouse doesn't work, but
Okay.
yes, I think so. So you could, but it depends on that disability policy. Because I have a client that was on disability, right?
Yep.
And so it depends on if it's taxable or tax free to you. And there's this little box on the disability W-2 form.
Right.
Or 1099, or was it? It would be W-2, wouldn't it?
Probably be W-2 if it's taxable.
Yeah.
Yeah.
And so, yes, but it was, they were able to contribute to a Roth, even on disability insurance. Not all disability policies, but just
FYI.
FYI, I don't know. I mean, if it's Social Security disability, then the answer is no.
And honestly, in most cases, I would say you cannot. But there are exceptions. But in this particular case, either way, if your spouse works, you can use your spouse's earned income for you to qualify to contribute to a Roth IRA. And if your spouse is in a retirement plan, there are limits in terms of you putting money into the Roth IRA. Actually, either way, whether in a retirement plan or not, and that's around $186,000. If you make less than that, to $196,000. Once you're over $196,000, you can't do a Roth contribution. If it's jointly below $186,000, you can.
Get social with Your Money, Your Wealth and Pure Financial Advisors. Follow us on Twitter at YMYW Show. To connect with us on Facebook, LinkedIn, YouTube, and Google+, just search for Pure Financial Advisors.
Got one more email question for you, Al.
Oh, good. Okay.
All right. I'm trying to determine if I should sell this company's stock or not. If the company's revenue stays the same when analyzing their statement, in the past 3 years have been profiting by 10%, but the fourth year is the exact same, if not a few cents more than the previous years. Would you sell that stock because of that reason, or would you hold on to see what happens? I know there's a lot more to look at than revenue, but what is the deciding factor to whether to buy or sell?
An individual stock? Well, I guess full disclosure, I don't, especially when it comes to your retirement nest egg, I don't really like to invest in individual stocks. I think you're taking more risk than you need to take. However, trying to answer this particular question, there's a lot of factors that go into stock pricing.
But here's the problem with that. I'm sorry to interrupt you.
Okay.
Not your answer, because you didn't answer. I interrupted you.
Yeah.
Is that
I was just about, I had such a brilliant, no.
It's already priced in the stock.
Yeah.
Is the problem,
That's
right?
the problem.
Well, if you sell it, the market they've already seen those numbers as well. Because I think his question is, hey, should I hold on here because just see is the market going to catch on to this?
So it's probably priced for being flat revenue, because that's what's been happening, and maybe just a slight increase in profits, I guess, as it says. But that's already priced in. Now, what could change that? Next year, all of a sudden, you sell a new product, you got a lot more revenue and a lot more profit, the stock price shoots up. But you don't know that information because it hasn't happened yet. Or on the other hand, revenue stays the same and now expenses go up and it starts losing money. The stock starts going down. But again, it's not known until it happens. So that's probably a good way to answer it, is the current stock price is reflective of everything known right now. The same thing you're seeing. So it's very difficult to make those sorts of calls based upon that.
Right. So, so you're looking at all the factors that everyone else is looking at. You need to know information that no one else has to make the best decision.
Yeah, and that's not always legal.
Oh, true.
As a matter of fact.
That is always illegal.
It's called insider trading.
Yeah, but they're trying to get a leg up here. This is what most, I think, individual investors try to do, is they're looking, all right, so I applaud that person for doing a little bit more research than most, kind of taking a look at what's going on under the hood. Hey, how are the revenues looking over the last couple of years? Hey, they're profitable. All right, so should I continue to hold on to this thing or not?
And so if we go back towards the beginning of my career, which was in the 1980s, I think it was, you probably had a little bit more likelihood of maybe getting a leg up because there wasn't the same amount of information, public information. There was information, but it was hard to get at. Right now, everything's on the internet, so it really is hard to get an advantage. But the books like Peter Lynch, Beating the Street, he talked about going to a mall and seeing what stores really has a lot of people, right? It's hard to do that now because everything is public on the internet.
Yeah, but that's all fodder, too. You know what I mean?
Yeah.
You could go back to ancient times, and still the markets are fairly efficient. They're perfect.
They are.
And I'm not saying it's impossible to get a leg up and really do all this research. All those boys did in 2008 when they kind of found some disparity going on with these mortgages and how they packaged them up.
That's
with
true,
those, CDOs and hey, this doesn't necessarily, and they made billions shorting that stuff. So yeah, it's absolutely possible. But the probability of sitting there taking a look at a balance sheet of a company that you own a stock in and then making your decisions based on that, it's very, very difficult.
But it's interesting that I think that's how most people think you're supposed to invest.
Sure.
Right? Because when you turn on any kind of financial channel, all they're talking about, well, this company's doing this, and maybe it's a good buy now, and that's what people, that's their frame of reference.
Right. Oh, this sounds pretty intelligent too. Maybe you should buy, steel companies, because the current administration wants to build.
Yeah, or
walls.
mining companies. Right.
And so it's like, okay, well, yeah, I think, Trump wants to build some walls, so he needs some steel to do that. So maybe I buy some steel, right? Because those, steel companies are going to be selling a lot of steel. Yeah, but everyone else kind of looks at that as well.
Right.
That's why those particular companies are up. Look at financials. Financials are up huge just because of, all right, well, here, the fiduciary rule, the DOL.
We're going to take away the regulations.
Yeah, maybe, slow down some of the regulations and things like that. It's like, all right, well, and then, then the jobs report. Yellen's going to increase interest rates. Well, it's already priced into interest rates. So
she told us that in December. She's going to raise it 3 times.
Exactly. So that's why it's a little bit more challenging. You listen to some very intelligent people, and Al and I are not one of those people.
We listen to them.
We listen to
and we try to regurgitate, and we do it poorly.
Poorly, very, very much so. But I think that's why you just have to have a good, solid, strong, investment strategy based on your specific needs, right?
Yeah, okay.
And just keep it simple.
Right.
We could get technical. There's certain areas of the market that you probably want to take more advantage of, but not trying to pick individual stocks. You want to buy a big basket of them, such as like value companies, lower price companies, right?
Yeah. We do
smaller
know,
companies?
Yeah, like you said, there's certain trends that smaller companies outperform larger companies over the long term. Not in every year. Lots of years they don't, but over the long term, same with value over growth.
Right. Small companies did very well last year. Well, they're doing well this year.
Yeah, but the year before they did poorly.
They're awful.
Yeah.
Right.
And the year before that, terrible. Right. So it's not every year.
So that's why you want a little bit in all, just to kind of keep it really simple. That's it for us today. For Big Al Clopine, I'm Joe Anderson. Show is called Your Money, Your Wealth.
So, to recap today's show, contrary to the myths, stocks and annuities may indeed be good investments for retirees, but it depends on your specific situation. Generally, you should have 8 to 10 times your last year's salary saved as you enter retirement and only withdraw about 4% per year in retirement, but most Americans don't know these things. and Joe's moving to the Republic of Congo to manage the fortune of an email scammer. Our thanks to Michelle Balconi, co-author of Let's Chat About Economics, for talking to us about our natural economic experts, our kids. Subscribe to the podcast at yourmoneyyourwealth.com through your favorite podcatcher or on iTunes, where you can also check out our ratings and reviews. And remember, this show is about you. If there's something you'd like to hear on Your Money, Your Wealth, just email info@purefinancial.com. Listen next week for more Your Money, Your Wealth, presented by Pure Financial Advisors. For your free financial assessment, visit purefinancial.com. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision. Your Money, Your Wealth opening song Motown Gold by Carl James Pestka is licensed under a Creative Commons license.